Last week Tesla dropped their Q4 earnings, and this week we're going to have a look at my updated forecast model to come to a stock price projection. There's one thing that's really important to note though. There's a lot of speculation ongoing at the moment about a merger between the newly formed XAI/SpaceX, I will call it X for now, and Tesla. Of course, no one knows how these things will go, but this could impact the business in several different ways. For example, if X would go public, they would become the second Elon company that everybody can invest in. If that happens, you can be sure that part of Tesla's shareholders will take their money out of Tesla and put it into X, which will not be good for the stock price. On the other hand, a lot of smart, connected people seem to be convinced a merger between X and Tesla is next. This could be positive or negative for the share price, depending on the price Tesla pays to acquire this new business combination. Whatever happens, today we're going to pretend that Tesla continues as is to make a forecast and come to a stock price projection for the coming years. If the merger happens, I will make an update of the model and integrate all the cool new business lines such as Starlink, the rocket launch service and the X platform. So let's start with the forecast. The share price corridor I'll show you at the end of the video is based on a detailed model of their business until 2030. In the next couple of minutes I will show you the most important components and assumptions. Starting from the top, the first thing we need to do is make a projection of Tesla's different business lines, because that will give us the revenue and gross margin. For some of them we have quite some data because they are pretty mature, but for others we will need to make a bunch of assumptions. Luckily, Elon is quite vocal about his future plans, so we have quite some stuff to go on. So let's start with their electric vehicle business. They just announced that they are discontinuing Model X and S after the current quarter. And this means that going forward, this business line will consist of the Model 3, the Model Y, the Cybertruck and the semi-truck. For now, I will ignore the possibility that Tesla could sell their Cybercab directly to consumers and businesses. So this Cybercab is completely designed for autonomous driving, primarily within Tesla's own Robotaxi network. There are no pedals or even a steering wheel, and you could imagine that people who can afford it might want to have their own private Cybercab. That would of course only be possible in regions where unsupervised full self-driving or FSD is legal, which today is basically nowhere. But that could change fast when it becomes clear to everybody that robots drive much safer than humans. In this chart you can see my forecast for the number of vehicles delivered in each model line. Please note that the numbers for Model 3 and Model Y are displayed on the right axis and the Cybertruck and Semi on the left, because otherwise you wouldn't be able to read it on the chart. Model 3 and Y will in the end represent more than 95% of the vehicles delivered according to my forecast. I think Cybertruck sales will basically stay flat, as it's not really a core product. The Semi numbers will probably remain relatively small compared to Model 3 and Y. But like I mentioned in last week's video, semi-trucks account for about 20% of vehicle emissions, so that's why they're important to Tesla's mission. In this chart, you see the revenue and cost of revenue generated by the automotive segment. I project a gradual increase of the gross margin towards 20% as Tesla optimizes costs and the Semi, with its higher gross margin percentage, becomes a bigger part of the total. Sticking with automotive, there are actually three other linked income streams. First off, Tesla receives and sells regulatory credits for having an all-electric product offering. So I expect this income to decrease over time as the competition also moves towards electric vehicles. Now, the attractive thing about these credits is that they are essentially pure profit, as there are no costs attached to them. I see this decreasing to around 200 million per quarter by 2030. Secondly, there's a revenue from their full self-driving or FSD subscriptions. So that's people who activate FSD in their cars for a monthly fee. I forecast this revenue by making an assumption on the size of the total fleet that is capable of FSD and the percentage of people who would decide to pay $100 per month for FSD. Today, the FSD-ready fleet size is about 6 million vehicles, which grows as Tesla delivers new cars, partially offset by cars leaving the fleet due to accidents, age, etc. So I project this fleet size to grow to 14 million cars by the end of 2030. The amount of people subscribing to FSD, or the take rate, is a little over 12% today, according to the CFO, and I project this to increase to 30% by the end of 2030. This results in the following revenue and gross margin. Since this is really a software business, I project the gross margin to be more than 90%, so very profitable. And thirdly, the segment that Tesla calls services and other, which primarily includes insurance, spare parts, repairs, and supercharging revenues. I model this category by taking the total fleet size and an average revenue per vehicle, which I project to grow over time as Tesla develops more value-added services. I also foresee a gradual improvement in the gross margin, but it will stay at the low end. Then there is the energy business. I split this up into hardware and software. So hardware consists of the consumer-oriented Powerwall and the commercial-scale Megapacks. Tesla has reported an analyst forecast consensus of energy deployments on its website since this quarter, so so I will use those figures. So there is fierce competition at the moment between suppliers of these types of batteries, especially in Asian markets. I include the assumption that both revenue and cost of revenue per gigawatt hour will decrease for this category, but resulting in a gradually improving gross margin. So the second category within energy consists of their software platforms that act as the brain of these batteries. They essentially manage the process of storing energy when it is cheap and sending it back out into the grid when prices are high and supply is limited. This helps owners make money, of which Tesla takes a cut, and it provides a service to the net by regulating supply and demand. The commercial product is called Autobidder, and on the consumer side it's VPP or virtual power plant, where many power walls are combined virtually to form one big battery. Then there are two moonshot businesses, which represent the biggest reason why people are excited about Tesla: Robotaxi and Optimus. So I will base my projection for Robotaxi on a number of cars in the Robotaxi fleet, which expands as they enter into more markets and add more vehicles in each market. Tesla has hinted at the following economics. The cars will drive about 80,000 miles per year, of which about 55% will be paid. For the rest, the car would just be driving around empty between rides. Then there is the price that Tesla charges per mile driven, which should start at around $1.50 and should decrease to about $1, and the costs per mile to Tesla. I assume that it starts at about 80 cents and that it will decrease to about 35 cents by the end of 2030. Elon has signaled that he eventually sees this decrease to about 20 cents per mile. All of the above results in the revenue and gross margin projected here. For Optimus, we also have some inputs. It will likely retail at about $30,000, and I expect the gross margin to evolve to about 30% by the end of 2030. Elon has talked about a very aggressive ramp-up, aiming for production of 1 million units per year. In the model, I project Tesla to hit that production target by the end of 2030. Here you can see the resulting revenue and gross profit projection. Summing all the different business lines together gives us this overview of the yearly revenue projection. To make sure we can still read the graph, I have added FSD regulatory credits and services and other under Automotive. And this is the same chart, but displaying the gross profit. So there's quite some significant growth ahead. So we're going to base our share price corridor on the earnings per share, or EPS. So we also need the rest of the P&L. In this chart, you can see a combination of the cost of revenue, OPEX, and operating income, expressed as a percentage of revenue. Together they total 100%. I expect OPEX will continue to increase as an absolute amount, but that towards the end of the forecasting period, it will decrease to about 10% of revenue. This results in an operating margin of 17% in Q4 2030. After taking into account some other items like interest income and tax, and adjusting for some non-cash impacts like share-based compensation, restructuring, and quarterly fluctuations in the value of their Bitcoin holdings, plus tax impact of these adjustments, we get to this forecast of adjusted net income. We need to translate this into a metric of earnings per share, and we do this by dividing the net income forecast by the forecast of the number of shares outstanding. I assume that the shares outstanding will continue to grow by about 1.5% over the period to account for share-based compensation and Elon's performance package. And here you can see the adjusted earnings per share, so just the previous slide but divided by the number of shares outstanding. To get a share price estimate at any moment in time, we simply need to multiply the earnings per share of the next 12 months by the price earnings ratio, or PE ratio, at which Tesla is expected to trade. To get to this number, we analyze the PE ratio of the past. The chart shows the average PE ratio at which Tesla traded, so not the stock price. The light blue part of the line is where I'm partially using my EPS forecast. If we look at the average of the past 12 months, we see that the stock has traded at an average PE ratio of 183.8, the straight light blue line, with a standard deviation of 31.5, the dotted line above and below the light blue line. And finally, if we take this PE ratio of 183.8 and multiply it by the earnings per share of the next 12 months for each day, we get to this stock price corridor. Again, the light blue line indicates where I expect the stock to trade based on the earnings I forecast and a constant price earnings ratio in line with that of the past 12 months. This chart shows that according to my model, there's an average expected upside of 106% versus today's stock price of 397 by the end of 2028. What you can also see is that the dark blue share price line is currently almost one standard deviation above the average PE ratio at which the stock has traded, meaning it is a little expensive according to my model. This chart is also very helpful in determining when it is a good time to buy and sell. From now on, you can see an updated version of this chart every week at the end of my news update videos. So lots of upside potential, especially if you manage to time your entrance correctly. However, like I said, there's currently a lot of uncertainty around the stock due to a possible merger with SpaceX/XAI. As soon as news comes out that impacts the stock in a major way, I will make an update of the model, as well as after every quarterly earnings call. For now, I want to thank you guys for watching, and I'll see you in the next one. These are just my opinions. Please supplement them with your own research before making an investment decision.